Yeah, hello everybody. Today I'm going to speak again about inheritance tax, and today I'm going to tell you what will happen if there have been several taxable transactions between the same persons during the last years. So this is still our part where we talk about German inheritance tax law so that you get some detailed knowledge about at least one inheritance tax law before we deeper analyze what can be happening in an international context. So, what happens? The basic principle is, or the basic problem is, where you have a progressive tax rate that people could, just by splitting up one transaction into several transactions, lower the progressive rate. Well, and the countermeasure here in Germany is, well, we do not accept that. We view all these split up transactions as a whole. When the last transaction is known, we add up all the previous transactions. Now, for technical reasons, you can't go back if somebody is 90 years old and then follow up all the former transactions since that person was born. And so you need to draw a line somewhere, and the line here is 10 years backwards to the past. So what the German law requires is that you look to the past and then follow up all taxable transactions which happened between that person and the same other person from which today's transaction comes. And that is all added up and then taxed as a whole. You can directly see what would happen otherwise. Imagine you have 1 million in a single transaction, that would cost 19%. Now, if you had instead 5 transactions, each year 200,000, then you would get off 5 times with 11%. So you would, just by splitting up into several single transactions, avoid a tax amount of 8%, which would be great. And so what we do here to avoid this is simply we say, okay, you just got within the last 10 years altogether 1 million. You will be assessed on the basis of that 1 million, so it costs you 19% of 1 million. So that brings no advantage anymore. This is the logic behind that. What you naturally can do is that you split up or you make donations to the next generation every 11 years. Then each donation counts alone. But then you have to wait always 10 years. So indeed, you could multiply the free allowance between you and your child by giving to that child every 10 years and 1 day an amount of 400,000 euro. Then 400,000 within 10 years is always tax-free. So if you do it, let's say, from the child's birthday onwards, at birthday, 10th birthday, 20th anniversary, 30th anniversary, and so on, in a way that it's never added up, okay, then you can indeed multiply the tax saving effect, but that costs you an enormous amount of patience. So at least the most relevant cases of splitting up one transaction into several months are counterattacked successfully by this procedure here. And that is why we do it that way. How is it done technically? Well, the problem is you can't, when you begin with the first time, you can't really say that you begin just by taxing the full million because you don't know about the full million. So you need to look for another way to deal with the matter. So the first step here is naturally when the first transaction occurs, you have no other idea. You only know about the first transaction, so this is just taxed alone. So imagine you have a taxable amount of 200,000, so you know nothing more about the future. All that would be speculation or only a promise. Nothing has happened more. So you know about 200,000, you tax on the basis of 200,000, which is at that moment absolutely still correct. So you would say 200,000, that costs 11% between father and son or mother and daughter and so on. So 22,000, please pay now. Just to simplify the example, I leave the personal allowances of 400,000 or so out of consideration. We do as if they not exist at the moment. Naturally, in a realistic example, which we later will have, these allowances exist, but just to understand the effect, we ignore them just now. So for the first tranche, or the first unit, you would just have 22,000. Now, second step after first step, naturally. Now, let's say 1 year later, father does again a donation of 200,000 to son. Now the assessment is reopened and done anew. So we now have an overall donation of 200,000 plus 200,000, so 400,000. And again, we do as if there are no personal allowances to hold the example simple. Now, in this bracket, 15% is due. That leads to a total tax amount of 60,000, which must be paid for 400,000. Now, there has already been a former version of our assessment where we charged our taxpayer with 22,000. These 22,000 have naturally already been paid at the last time. So what is still due? Naturally only the difference, 38,000. Good. What comes after the second step? Well, the third step, and that would be, again, a transaction happens, a donation, 200,000. We reopen the assessment again. Now we charge our taxpayer based on a total acquisition of 600,000. Tax rate is in that bracket still 15%. The new tax total is 90,000. We look to our files and say, okay, congratulations, dear taxpayer, last time you have already paid up to an amount of 60,000, so please just give us the remaining difference, 30,000, and so on, and so on, and so on. This is how it works, how former events are taken into account. Here is the legal source where you can look it up. If the person who acquires something already, if the person who acquires something acquired already something from the same person before within the last 10 years, those several acquisitions are taken into account by adding their value to the value of the present acquisition. And then from the due tax for the total acquisition now, that amount of tax is deducted which would have had to be levied according to the personal relationship of acquirer and on the grounds of the present day's rules. So exactly what we did just now is described here. When the assessment is reopened, then you just compute the overall tax for the total of all the acquisitions, and then you just deduct, you credit to the final tax liability, you credit that amount which has already been charged last time because that has already been paid. Okay, so this way we can effectively prevent that the progression can be lowered artificially. Now, naturally, life is not always so easy as it could be. In exams, usually it is easy. But in real life, it can happen that the tax law changes. The rate goes up or the rate goes down between the first and the second transaction. In that case, we have to think a bit what can be just and fair. And the German legislature just said, well, I'm going to describe that to my people, but I will naturally not explain that, so they will have a strange feeling. So here, if we look to paragraph 14, it says you have to credit, sentence 2, that amount which would or which is due for the first transactions, the earlier ones, under the rules of today, so with the tax rates of today. Now, if in the past the tax rates have been higher, then you credit the amount which actually has been paid in the past. Sentence 3. Instead of the tax on the former acquisitions determined according to sentence 2, so according to the rules of today, the tax actually paid for it in former times is to be deducted if that tax had been higher. So here you require two calculations if there has been a change of law in the meantime. Now, there is, however, a kind of a restriction. If you credit the higher actual amount of former days, the tax which you then calculate by deducting it from the present transaction may under no circumstances lead to a tax which is lower than if the actual last, the current last transaction stood alone. So you have here altogether three different limits to observe. Well, let's try to understand a bit of the logic, and afterwards we will do exactly what the German legislator does. We will just do what the law says and try to understand the rough idea, and we probably can't follow it up really in the details. So if the tax rate were increased since the last time, then we want to avoid a retroactive increase of the tax rates relating to the former acquisitions. That is the reason why we do normally not credit the actual tax paid at the former time, but the tax of today. Imagine, to illustrate that, today's tax rates shall be as they are given in the tax tariff table, which you know. And now we assume that in a few years, when the second transaction comes, all the rates are increased by additional 10 percentage points. So the first bracket turns from 7%, which is the rate of today, to 17% in tax plus 1 for the first bracket. 11% are changed to 21%. 15% will be changed to 25%, and 29% for the fourth bracket. This is now just in my imagination. So please never think that these rates would become existent in the near future. No, they are not going to be established. It's just for the sake of my example, and I promise that I will never end up as German Minister of Fiscal Affairs. So there is not even a theoretical chance or risk that this example will come true. It's just to illustrate what happens. So let's imagine the first transaction was about 500,000, and the second transaction happening now under that increased tariff is also again 500,000. Again, to make things simple and to understand just how it works, we forget about all the personal allowances for reasons of simplification. So if we had already known all the future when the first transaction happened, we would have known the right progression for our first 500,000 would be the progression for 1 million. At that time, that would have required a tax rate of 19%. That was at that time the valid rate for 500,000. And at the time of the second transaction, the correct progression rate would have been 29%. Now, what really happened was, at the time of the first donation of 500,000, this was assessed under the old tariff and for 500,000, so 15%. So we charged our taxpayer effectively with 75%. Had we known at that time that another 500,000 was still to come, then we would have known that the appropriate rate under the law of that time would have been 19%. So we would have charged for that first 500,000 then an amount of 95,000. We would have taken 20,000 more. So this was the progression advantage, let's call it this way, or the avoided amount from the lower progression, 20,000, that was just saved due to the fact that the future was unknown. Now, when the second event arrived, we charged our taxpayers with now 29%, the new rate on the full million, 290,000. Now, unfortunately, the increased rate would then also be applied retroactively to things which happened 3 years or 4 years ago, when the first donation was made. At that time, not 29%, but 19% was the relevant rate. So we do want to avoid that we increase tax rates with effect to the past. That's rather unfair. That would never be done. And so if we credited here the historical tax, then we would indeed, let's say we level up, we levy the 29% retroactively also on the first part. That would be unfair. So we try to make the first part immune against the increase of taxes by just doing as if today's law had always existed and have always been valid for also already for the first 500,000. So we credit the tax amount under the new law. So we credit, had we already known what was going to happen, we had charged 25%, that's 125,000. So as a consequence of that, we would have taken for the second transaction 290,000 minus 125, that's 165. If you reflect a bit, what are the parts of that second amount? You would have 29% regularly on 500,000, the second 500,000 would explain 145,000, and you would have 20,000, which was a kind of retroactive collecting a bit more for the first tranche, and that surprise would exactly be that what we have saved under from the lower progression. That was exactly that. By the way, that it is exactly that might be a coincidence in the in my data. Don't take it for granted, but at least here you see how the thing works. On the other hand, what happened if the rates had been lowered since the last transaction? Then the problem would have to require some different reaction. Now, imagine that if we have a first transaction of 500,000 in year 1 and a second one of 500,000 in year 2. In that case, if we had known the full future, then 19% would have been correct as the progressive rate for the first tranche. And in the second year, let's imagine, or in year 5 or so, let's imagine that the legislator, in a fit of benevolence, lowers the tax rate all by 5 percentage points. So the first bracket goes down from 7% to 2%, the second one from 11 to 6%, and so on, and 14% for the fourth bracket. So had we known the future, and indeed we know all what happens at the end of year 5 when the second donation comes, then we know the appropriate tax rate is 14%. So we would charge the second half with 14%. But if we then apply everything to the first thing, we would only credit 14% to the first thing. And so that's a problem. Probably you would credit too low an amount. And here the law says, well, let's make a compromise. If we had already known everything which happened, we would still have 19% as appropriate tax, 95,000 for the first 500,000. Now, at that time, we charged only 75,000 because we only knew about the first 500,000 and didn't know that 500,000 was still to come. So when the second donation is made, a certain retroactive increase is justified to justify or to react to the fact that the progression was broken and split. Now, so the tax was, from the perspective of the first tariff, too low by 20,000. Now, the second time, we would say 14% should be demanded. Under the new rules, you would only have charged 50,000. So if we calculated that based only on the new tariff, we would demand 90,000 for the second tranche. That could be explained as 14% regular tax on the second 500,000 minus, plus 20,000, which is, by the way, in a certain way, simply exact. However, actually paid had not been 50,000 but 75,000, and the German law just says then credit the 75,000. That would drop down, or let our charge then drop down to 65,000. That would be explicable at 70,000 minus 5,000, and the minus 5,000 is 20,000 additional charge from leveling up the progression, minus 25,000 from drop down of the tax rate. Now the law says here, I want to avoid that the drop down of the tax rate later draws down the adequate tax of former times. And so what I do is I say that you have to guarantee that the tax amount for the second donation is at least that amount which would have been levied if the second donation had been made alone. So if the tax rates have been lowered, that should not end up in a way that the higher tax rates of former times now can be used to lower the tax rates for the second half of the second transaction. Here it begins to become a bit complicated, and indeed it is, but here you have an idea what is perhaps behind that complicated rule. You should keep in mind that all that plays absolutely no role if the tax rates do not change, because then the new tax and the old tax, so the tax charged under the new tariff and the tax actually paid in the past under the tariff rules is the same. So keep in mind that these 14.1, sentence 2, 3, 4, and so that these things only play a role if the tax tariff has changed, and that does not happen every day. So, there is also, when you now have the idea that the whole thing becomes a bit confused and you do not understand the mathematics in detail, congratulations, you are evidently in good company, because the German legislator said in 14.3, we install something like an emergency brake. We say such an additional amount which is levied for a second, third, or fourth taxable event shall under no circumstances trigger an additional tax which is more than 50% of that additional event. By the way, if I understand that correctly, there might be situations where, due to 14.3, splitting up donations in cases where very high amounts are in play might really end up effectively with some advantages. Probably not in tax class 1, but in tax class 2 or 3. Yeah, so if I have now confused you enough, then we should try to put things straight again and to bring some order into our heads. So let's imagine an example. There is a father and a son, and son, dies. Here I see I first abbreviated, called him N, and then I called him S. It's the same guy. So they both live in the inland, so unlimited tax liability applies. And father dies and leaves the taxable property to son, and that is 5 million. Now, 5 years before, F had already made a gift of 2.0 million to Son. Son has now under the testament to give a legacy of 500,000 to his first cousin C. And now the question is, how is the acquisition by S to be treated? And well, this was the question, and what we then need is naturally a solution. And here is that solution. The inheritance is a taxable event under number 1 of the Inheritance Tax Act. Because it is an acquisition on grounds of death, you find inheritances in the list of 3.1 number 1 Inheritance Tax Act that clarifies, yes, that is an acquisition of ground of death. The former donation was also taxable event, 1.1 number 2, because it is a donation between living persons that can be checked up in 7.1 of the Inheritance Tax Act. I hope it's number 1 there, but I would have to look it up, as you always should do, by the way, too. Never believe anything, always look it up in the text of the law. Both transactions were taxable under the rules of unlimited tax liability because the persons involved lived in the inland when things happen. At least you remember one of the persons in the inland is sufficient to trigger unlimited tax liability for the event. So we don't have to bother where the money was and which kind of property it was. Everything which changed the owner everywhere, all over the world, counts. The arisal of the tax has to be determined. Okay, that was for the first donation on the moment when the donation was made. On the second case, when the inheritance took place, well, when the inheritance took place, that means when father died. Now let's go to the calculation of the tax base. The tax base is, as we have nicely learned it, the enrichment of the acquirer under German law. That was in 10.1 of the Inheritance Act, the Erbschaftssteuergesetz. So that was 5.0 million minus the liabilities. So a liability is here the liability from the legacy. So we deduct the 500,000 for the legacy. Then what people always forget is the funeral cost lump sum. We have no additional proofs for funeral costs, but the person where the money came from died, so must be put under the earth. So that means 10,300 are deducted if no higher costs are proven, and they are not proven because the case data do not tell us more. Then naturally, father to son, that's tax clause 1, free allowance, 400,000 for a child, so we deduct that too. And then the ominous paragraph 14 comes and says, okay, and then please add up the former donation, because that happened between father and son, so the same two persons, within the last 10 years. So we add this up, and if I'm not completely mistaken, we end up with the taxable amount of... Oh, that seems to be wrong, isn't that? No, seems to be right. 500,400, yeah. 6,089,700. Now we look to the tax tariff table and find 23%. That leads to 1,400,631. Now the last threshold is 6 million, and so we would have, as we always must do. But we really should not forget to make the 19.3 test. That means the maximum for the tax is near the beginning of a new bracket, fixed to the tax which would have been due at the end of the last bracket, plus at maximum half of the amount by which we have surpassed the last bracket. So to calculate that, last bracket was 6 million. In tax clause 1 for 6 million, 19% would have been the appropriate tax rate. So 1,140,000 would that have been. And the maximum which comes on top is 1/2 of the difference between the taxable amount and the last threshold. Taxable amount is 6,089,700. 6 million last threshold. The difference is 89,700. Half of it is 44,850. This is or this leads us to a maximum tax at that point of this tariff. 1,140,000 plus 44,850 is 1,180,850. This is the maximum. So as this is lower than the tariff, the tax under the tariff, this maximum becomes effective and cuts off the rest. So the tax which is demanded here for that taxable amount is 1,180,850. Now we have to look to the assessment for the first transaction. 2 million at the former time had been assessed as follows: 2 million minus a free allowance of 400,000 minus no funeral costs, because at the former time there was no funeral. So 1.6 million were in play last time. The tax rate there would already have been, or would have been 90%. That leads to 304,000. The 19.3 test can be made, but it does not change this figure. In an exam, you would make the 19.3 test naturally for that former assessment too. So the final assessment says you owe us 184,850 minus 304,000. That ends up with a final payment of 880,850. Now that is how it is done. And this is what you should understand. This way one works with a sequence of several taxable events between the same persons. By the way, what happened if now the 2 million had not come from father but from mother? And then the answer is, well, then it would be a completely different movie, because if the 2 million came from mother, they are not added up. Only taxable events which happen in the relationship between the same two persons are added together. This, by the way, leads you and me to an interesting consequence. What if father doesn't give 2 million to son, but give 2 million to mother, and mother, a second later, makes a donation or a gift to son, 2 million. In these cases, ladies and gentlemen, one would probably say, hey, that was prearranged. Do you remember from your basics lecture that there was something which was called tax abuse? When you formally do as if you do something, or as if you do not do something which triggers a tax. So here, that father gives 2 million to son, that's taxable, or that increases the tax. But now father chooses a different legal way, which is a bit more complicated, more unusual, but in the final effect has exactly the same result. So if father just gives the money to mother and mother hands it on, that would be usually classified as a tax abuse, and one would say the whole maneuver was just meant to mask that 2 million had to go from father to mother. And now the question is, tax abuse is only if the prior motive for the course of events was to save taxes. Now, in practice, people would try that mother can give money to son and that the whole thing is not prearranged. For example, in Germany here, the courts would very often decide the current line of, or the current view of the courts is that if father gives 2 million to mother, and then mother has a free possibility to decide if she wants to keep the money or pass it on. If you can prove this, and this is proven to the conviction of the court, that mother could freely decide if she wanted to keep the money, then it was a donation to mother and a donation from mother to son, and not an abusive masking of a straight father-son donation. In practice, that relies on what a judge in court is willing to believe, and usually they are, well, they are a bit experienced in the field of taxation, so they will not believe every story which you tell them, which is artificial. But indeed, there is still the reason or the rule: added up are only transactions where the two same persons are involved. So if the money comes from somebody else, even if it's mother or sister or some close relative, then it's not added up. Only if one can say, no, this money does not really come from mother, it comes from father, and that was only masked by a strange way of behavior under the civil code. Good. So keep in mind how that taking into account of former transactions works. And I think that should be enough for today. Yeah. Hope to see you back soon on this channel, and I hope you enjoyed that this video was a small one. Goodbye, till next time.